All right. Good morning, my fellow capitalists and profit seekers. This is your growth stock guru, Rick Action Jackson. Thanks for joining us. First, let me state this show is for education purposes, where I'm going to explain why a stock meets my top quintile filter process as a buy or a sell. We're not going to discuss sells today, but sometimes I do. This is not financial advice. You should run all these ideas past your financial advisor, especially if you're new to the stock market. Individual stocks carry a lot of risk. You can lose money. Just sharing with you ideas and education. Discuss this with your financial advisor before acting upon it. Okay, so the first thing we have today is RH, which is called RH.com. That's shortened for its old name, which was Restoration Hardware. They got a prime time right out of GQ and Vogue magazine CEO 4 years ago, and he's completely changed the company. And here's the target market. The nouveau riche that want to look refined. It's a gold mine. All these Restoration Hardware stores, 80% of them have been shut down. The ones they've kept were in prime location and big enough to house the new vision. The new vision is this is a high-end furniture store. Furniture is their main source of income, but it is an interior decorator's showroom fantasy. Every room is decked out top to bottom in high-end carpet, high-end drapes, high-end furniture, high-end everything. And they put a high-end restaurant in each store so that they give you more reasons to come in. And this is the type of restaurant where you're going to pay $20 for a glass of wine, so they know no riffraff's going to bother coming in. They don't want riffraff. They will have launchings of new furniture lines or drape lines with free champagne or white wine. They'll attract all their decorators, and the decorators are allowed to bring prospects or customers. And here are the statistics in the U.S. If you're going to be in the top 10% of America's population and wealth, you're going to need about $13 million in liquid assets, and that does not include your home. I mean, $13 million in cash, stock, bonds. That's what it takes to enter that club. Here's the interesting statistic on that group. Over half of the people in that demographic are self-made, which is totally different from Japan, China, or Europe. A lot of inherited wealth in those nations. The inherited wealth in this country pretty consistently gets blown within 2 generations. The Vanderbilts don't have a single member of their family anymore has more than $10 million. Cornelius Vanderbilt was the richest man in the world 4 generations ago. Interestingly, the Kennedys have stayed rich, and Joe Kennedy bought a lot of life insurance on all of his grandchildren. So did the Rockefellers, and they're still in the top of the rich in America. But the Vanderbilts did not, and they're not uncommon. Most of the wealthy in this country, their grandchildren and great-grandchildren won't be anywhere near as wealthy as the creator of the wealth. Now, when you work hard to make a lot of money, you don't know a lot about furniture. But you want to have a nice house, and you want to have it look good, and you want it to have nice furniture. This is for the people that didn't grow up in castles or rich homes, but want to have a nice-looking rich home. They also have a new boutique hotel chain where they only have executive suites. There's no regular rooms. Every single room in that hotel you can order for your house. Hey, I love the bedroom in that hotel room. Can you get me that bedroom? The king-size bed, the drapes, the furniture. I want that room. I want the living room in the middle of that suite. And every room has different designers. They've got about 40 designers in their quarterly fashion book that goes out once a quarter and has all these different ideas for furniture and room layouts. And this guy gets it. He knows his audience. He knows what they're looking for. He's built alliances with all the interior decorators. And between the hotels and the restaurants, he gets a lot of people to check out what they're doing. And it's very simple. You say, hey, I stayed on this room in the state. I really like the bedroom. Can you recreate that in my house? Yes, we can. No problem. Now, this is for people who are willing to spend 20 to 50 grand on a bedroom. They're out there, ladies and gentlemen, and this store makes it easy for them to order. So let's look at the chart on this. This was a $700 stock 5 years ago. It collapsed during COVID, and then just as it's getting back up on its feet and got back up to $400, Trump started a trade war. Well, mahogany doesn't grow in the U.S. anymore. You want mahogany, you got to go to Vietnam or Brazil. And Trump put 50 to 200% tariffs on those countries. Now, what's interesting is that the Supreme Court's reversed a lot of those tariffs. And the companies that have paid those tariffs are starting to get refunds. This company is going to get a ton of tariff refunds over the next 12 months. And the traffic in their showrooms has picked up a lot recently. Alan Greenspan used to say 15% on the S&P 500 adds on an extra 1% in GDP because the wealthier are willing to spend more money as their wealth goes up. This is RH's clientele. As the market goes up, their clients spend more money. And I feel very confident the stock has bottomed here. They're opening 3 gigantic stores in London, Paris, and Milan this year. And they're also opening up a new one in Napa Valley. And they plan to have 300 of these stores globally. They've only built out 90. They know where the wealthy live. They know where to place these stores. They know how to get them in there between the restaurant and the wine and cheese and champagne receptions with interior decorators. All they needed was to get these tariffs behind them and get the economy going again. And I personally believe GDP is a lot higher than 2% right now because the type of profits most corporations are reporting is usually synonymous with 3 or 4% GDP. And GDP is the one number the government releases that will typically be completely different 2 years later. Because when they release the GDP numbers, it's a total guess. They do surveys, but most people don't answer phones or faxes anymore. It's very incomplete data they make these guesses on. They don't really know what GDP is until they get all the tax returns in. And as you know, tax returns go to the government 4 to 9 months in the past. And then it takes the government 3 to 6 months to process it. So we're not going to really know what GDP is until 2028 for 2026. But I will bet $1 that it's a hell of a lot higher than 2%. Good economy, a good stock market is what makes this company do great, and their last 2 quarters are great. And with these tariff refunds, I expect they're going to be beating the consensus going forward because it's a nice cushion they have every quarter, getting back all these tariffs that they paid that destroyed the stock over the last prior 12 months. So Restoration Hardware, my target on this is $334, which is based on a 35 multiple, which is low. This company typically is sold at a 40 or 50 multiple and was a higher price stock on $9.44 in earnings. And if this company keeps beating earnings like they have in the past, that's probably way low. In fact, when you add in the tariff profits, which I don't think most analysts have done, I wouldn't be surprised if this company in 2 years does $12 in earnings. But we're going to use $9.44. Okay, that's Restoration Hardware. Next, we have the ticker on this is OPFI. OPFI. Let's go to the chart. Those of you that watch this show on a regular basis know that I was pounding the table on Upstart when it was a $27 stock. It's now a $32 stock. One of the reasons why I really liked Upstart is that this Upstart is a very similar model to OPFI. What these companies both do is they've designed computer programs that do underwriting without human beings. And what they both do is if you want to get a loan from them, you have to give them access to your bank account. You don't like that? Don't borrow from them. But here's what they do. They give you an answer in 5 minutes and they give you the money tomorrow. I've personally worked with Upstart twice to borrow money for my tax return because I owed 10, 20 grand and have it laying around. I didn't want to sell a stock. didn't want to use a credit card, and didn't want to go anywhere else for a loan that would involve a lot of paperwork. I just got the loan in 5 minutes, filling out a 2-page questionnaire and giving them access to my bank account. These computer underwriting modules, they have lower default rates. They have higher closing ratios. And their costs are half what human being underwriters are. And the underwriters that are human don't look at what these guys look at. Like the Upstart CFO is explaining to me that, if we got a guy with a great credit score and a good income, but we go through his bank records and we see he's taking $4 or $5 grand in cash out every month, and he only makes $100,000. Something wrong there. He's either got a gambling problem, or he's dealing drugs, or he's doing business under the table off the IRS radar. Whatever the answer is, it's not normal behavior. They don't want to go near that guy. That's something a human being would never pick up. A human being's not going through 12 months of their bank records. They're going through their W-2s. They're going through their credit history. These computers are making better decisions than human beings. And the reason I liked Upstart so much is they're in the process of buying a bank. Well, OPFI is 1/4 the size of Upstart. It's a much smaller lender. But its biggest investor is Goldman Sachs. Goldman Sachs helps them raise all their capital. And they just completed buying a bank 3 months ago. Now, for Upstart's telling Wall Street that by owning their own bank, it's going to lower their cost of funds 200 basis points or 2 percentage points, which would drop right to the bottom line in profit. This company says the bank they bought is going to cut their cost of funds by 3.5%. So either they're overestimating that advantage or Upstart's underestimating the advantage. But this company under 10, I think, is a steal. My target on it is $24. And we get there by putting a 12 multiple on the $11 they're supposed to make in earnings in 2 years. This company's got very little debt. It's got a lot of cash on the balance sheet. It's not well known because it's tiny. But as they keep coming in with profits that are above expectations, and they've started to pay a dividend, more and more people are going to pay notice of it. So that's OPFI. It's a small, tiny company, but I think it's going places. And as you probably know out there if you're experienced, but many people that watch this show are not experienced, small companies are more volatile and more dangerous. So know that going in. Third one I have today is a very fascinating company that currently has new board directors because investors have gotten a little too impatient with improvement. This company has no debt. It has a lot of cash. It has, and you're getting $5 a share in cash here. The ticker is RDCM. Radcom, let's go to the chart. Radcom is Israeli based. It's more difficult to do a leverage buyout in Israel than the U.S., but it is possible. And they put 2 new board directors on that are really pressuring the company to either buy back the stock or start producing results that get the stock moving. So there's 2 ways you can win here. They could buy back a lot of stock. They could buy back almost half of their stock with all the cash they have, and they generate profits, so they're going to have more cash down the road. Or they can start producing numbers that really catch people's eyes. This company's pretty consistently grown 5 to 15% a year, but I think the growth rate is going to accelerate significantly. What do? They help cellular providers increase bandwidth. Now, I talked to all of you about a similar company that adds bandwidth to the spectrum. What these guys do is they add bandwidth to tower communications. When you're in a car and you don't lose a phone call, there are microwave beams that connect the cell phone towers, and those beams transfer your call from one tower to the other. This company dramatically expands the capacity of towers to do that. If you lose a call while you're driving, very often it's not a problem of there not being a tower nearby. It's that the tower nearby didn't have any capacity. So this company is very active in India right now. Why is that significant? India is the largest cell phone market in the world. Most Indians do not have a TV or a PC. Most Indians watch their video entertainment on their phone. And video over the phone eats up a lot of bandwidth. And they've got 1.4 billion people and 1 billion cell phones, more than there are in China. India signed a defense agreement with the United States, Australia, and Great Britain 3 years ago, where the four of us are going to coordinate our submarine patrols of the Indian Ocean and the straits around Singapore. Basically, this is an alliance to shut down China's ability to trade if China gives us a problem. Part of this agreement was that all four signers of the treaty had to stop buying cellular equipment from Huawei, which is China's largest cellular phone equipment maker, and they had half the market in India. Well, they can't buy from them anymore, and they got to start announcing other vendors. Now, another reason why these two people were put on the board is that this company would fit into the product line of Nokia or Ericsson very nicely. So they think they could sell the company for $20 to $25 to Nokia or Ericsson, no problem. They just put a for sale sign out front. So you got three ways for this company to win. The growth rate could accelerate from India business, and it's the business available to them in India. If they get just a third of the market, it would double the company. You could get a big share repurchase program, or you can see the company sold. But the board, if you look at the 5-year chart here, this stock's done nothing for 5 years, even though the company for 5 years has grown their earnings every year. The board has lost its patience. They're like, you got to do something to get this stock going. So if they don't start announcing big contracts in India in the next 6 months, I would suspect they're going to sell to Ericsson or Nokia. So that's RDCM, very little downside. There's great chart support, $11, $12. You've got $5, $6 a share here in cash. And I think this could easily be a $22 stock. Some people say the buyout value of Ericsson or Nokia wanted to buy them is $30. I'll take 22, buying it at $12.99. Again, this is a small cap, but what most small caps do not have is a lot of cash on the balance sheet. This one does. So I'm not going to say this is a safe stock, but as far as a small company goes, it's as safe as they come. And there's three ways here to win. So that's RDCM, Radcom. Under 14, I think the risk reward is fantastic. $3 down, 15 up. That's all we got for today, folks. Enjoy your weekend, and thanks for checking in. We'll see you down the road.